Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. Just look at this stock market map, split right down the middle, big cap tech deep in the red, nearly everything else in the green. Let's take a look at the percentages. The S&P 500 is down 0.7% today. The Dow is actually flat. And tech, the Nasdaq down 2%, dragged down by weak earnings from Microsoft and Google. We'll get into those earnings reports later in the video, but let's start with the daily chart for the S&P 500. This was the first day really since we had that short squeeze rally off the Wall Street Journal article that we've seen a bearish looking candle, a tombstone rejection candle. Now, momentum is still bullish on the daily chart. We printed another green day. We also printed another green day on the histogram for the PPO. But we're seeing a rejection at a very logical level. We have the 50-day moving average, a descending 50-day moving average. We also have this level of consolidation where we saw a lot of choppy trading in the past. We're also pausing at the upper weekly expected move. We track the upper and lower weekly expected moves for the S&P 500 and a plethora of other products and stocks that I put up at the beginning of every single week in our trading community. Check out the link in the description below if you are interested. Now, we're seeing some very interesting developments, not necessarily on the S&P 500 chart, but on other charts, including, let's take a look at the VIX. The VIX actually collapsed all the way down to the 50-day moving average. Now, why is that important? Well, let me show you what happens when the VIX is in an uptrend, right? And it retraces back to the 50-day moving average. We had it happen here. We had it happen right here, as well as here. We also saw it happen back here and here. And what tends to happen, everybody, is that the VIX tends to rebound, at least for a brief moment, where we see weakness in the stock market return and volatility picking back up. In fact, let's add the S&P 500 on here so you guys can see what happened in every example. We had a retracement to the 50-day moving average here, then we had a sell-off. Another time we had it here, another sell-off. Boom, we had it here, we had a sell-off. Again, we had it right here, we had another sell-off. And right over here, we had another sell-off. So do not be surprised to see some weakness come back into the market, especially as we've now hit a descending 50-day moving average and the upper weekly expected move, and we printed a bearish looking tombstone candle. Now let's take a look at the triple Qs, the Nasdaq. The Nasdaq continues to underperform the S&P 500. Unfortunately, big cap tech continues to underperform the rest of the market. And this is bad news for relief rallies, right? Let me show you why. Up top, everyone, is the ratio chart of the Nasdaq divided by the S&P, and down below is the S&P 500. And what do you notice? Let's take a look at the ratio. In every single relief rally we've seen in the stock market, this ratio usually moves to the upside, right? We had this very sizable June rally. We also had this mini May rally, and then we had that March rally. Every single time, everybody, we had the ratio move to the upside. This time we're not seeing that. We're not seeing this relief rally being led by tech, and this is very negative for the stock market. Tech is the largest component of the S&P 500, and it's companies like Google, like Microsoft, like Apple that drive the market. So be very careful when you see something like this happening, where the stock market is rallying, but it's not being led by tech. In my book, that's a very big red flag. Another red flag, a major red flag, is this, everyone. This is the dollar index. We had a massive breakdown below the 50-day moving average and outside of this ascending channel. This hasn't happened before year to date. It happened very briefly here, and then we recovered the next 2 days. We'll see if that happens again here. But the worrying sign is that we had a massive breakdown in the dollar index, and then we had a very weak, very timid market today. We did not see that reciprocated by the market with a relief rally. And so that's a warning sign that money is flowing out of the dollar, so the dollar is weakening, but it's not flowing back into equities. It's not flowing back into the S&P 500. It's flowing back into long-term treasuries, into the TLT. Now, this chart is not the TLT, it's the TLT divided by the triple Qs. It's a ratio chart, and it's what I like to call the imminent doom indicator. Now, the imminent doom indicator hasn't flashed a signal just yet, but let me show you what I'm talking about. The ratio chart up above measures the relative performance of long-term treasuries against the Nasdaq. Now, this relative performance only shoots to the upside when we get really nasty crashes like the 2020 crash. Now, if you go back, you see this all the time. When this ratio pushes to the upside, we see a massive correction / crash in the stock market. This happens systematically. Look at this, everyone. In 2016, we had the exact same thing. And if we go all the way back to 2008, look at this. Now, why am I pointing this out? The signal hasn't flashed quite yet. Down below is the TLT, the long-term treasuries in the black and blue, and we're seeing a sort of a bottoming formation, a V-shaped recovery in the long-term treasuries. But at the same time that we're seeing this massive move to the upside in the long-term treasuries, we're seeing the Nasdaq weaken. That's a very bad sign, again, indicating that money is flowing out of the dollar as a safety asset into long-term treasuries, not into the S&P 500 or the Nasdaq. And so we're not seeing this weakness in the dollar reflected positively in the stock market. Let's take a look at the 10-year yield. Again, the 10-year yield continues to move to the downside. It continues to correct to the downside, but we're not seeing that reciprocated by a rally in the S&P 500. Same thing with the 2-year yield, continues to break down after breaking down out of this ascending wedge that I've been following for weeks now. We're seeing this breakdown. We had a brief rally in the S&P 500, or now we're pausing. We're seeing weakness. We're not seeing the same weakness in the treasuries. Usually the market begins to reverse to the downside when yields shoot to the upside. We're not seeing that. What we're seeing is a late stage / end stage collapse behavior when commodities top, when yields top, and when money begins to flow out of the dollar into gold and into long-term treasuries, not into the S&P 500. Now, with that being said, we need to see this happening consistently for the imminent doom indicator to flash a sell signal. We haven't seen that quite yet. In fact, we're still seeing risk on behavior. Up top, everyone, is the gold divided by the S&P 500, one of my favorite risk on charts / indicators. And look at this, I alerted everyone that this signal was triggered back here on the 14th of October. When everybody was actually worried that the market would see a waterfall sell-off, we actually called the bottom here. We said, no, we're not going to see that quite yet. We're going to see a face-ripping relief rally, a violent short squeeze. We're seeing that play out now, sucking in more and more traders into what is now going to be a very dangerous trap. Again, as indicated by the lack of participation by tech. Now, tech can begin to participate. We could see that starting, as this may end up being a double bottom formation, and we may end up seeing tech participate in this rally. If that ends up happening, we can expect the S&P 500 to push even higher, significantly higher. Now, that's what the gold to S&P 500 ratio is suggesting, that we will see very likely a stronger push to the upside after we get big cap tech earnings out of the way. So we will see a lot of choppiness and volatility as we get more and more earnings report released. But if we get that out of the way, and then we could see a nice bounce in the Nasdaq, with the Nasdaq perhaps beginning to lead again. Another indicator that is pointing towards that direction is this. Up top, everyone, is the percent of stocks above the 200-day moving average in the S&P 500. We track this monstrous bullish divergence. You would have to go back all the way to 2016 to see anything like this. The last time we've seen a divergence like this, the stock market rallied by 15% in 45 days. This divergence is still playing to the upside and there's still steam left in this rally. Let's take a look at the CPC buy and sell signal. This is my own variation of the put to call ratio buy and sell signal that I've been working on for a long time, refining and perfecting. Year to date, this signal has been 100% accurate in tracking stock market reversals with perfect sell signals and perfect buy signals. In fact, if you only followed this indicator and nothing else, you would have made over 400% just in the last 6 months. If you're interested in setting this signal up, I made a member exclusive video on how to set this exact signal up with a free TradingView account for our trading community members. If you're interested in joining our trading community, it's $30 a month if you sign up for the annual membership, and it's where I post every single trade and investment as well as real-time, live, daily, pre-market, intra-market, and post-market analysis. As of right now, this buy signal continues to be active. Now let's jump into Microsoft. Microsoft reported weaker than expected growth in its Azure cloud computing segment, the fastest growing segment in the company, and it reported weaker than expected growth. And as a result, we saw this massive gap to the downside. Now, members of the trading community will not have been surprised by this move at all. In fact, yesterday we called $235 as the very likely price target for Microsoft after earnings. That's exactly what happened. This is what the trading community looks like, everybody. I'm at UTC +3, so 3:22 p.m. for me is 8:22 a.m. Eastern Time. Now, I did make an alert before the market opened today about Microsoft for the legends that were trading Microsoft. We're back down to $235, which is what we expected would happen yesterday based on the levels on the chart and what the options market was pricing in. This is a huge gap down, so expect one of two things. One, a recovery with buyers stepping in. Two, stagnation at this level for the day. Now, very interestingly, we ended up seeing both, right? We had a rally develop early in the day and it topped at midday, and then we had a sell-off that took us all the way back down to the same opening price. Now, some members did take advantage of this massive gap to the downside. They traded it to the upside and made over 30% in profit in a single day, which is very, very impressive. Congratulations. Other members joined me in a different trade in a very specific stock that I've been trading around for a while now. If you've been following this channel for long enough, you will know exactly what stock I'm talking about. And we locked in another beautiful day of profits, continuing our zero losses winning streak for October. We've been so incredibly lucky. I'm so thankful that this month we've had zero losses. All of our trades were winning trades, with the smallest netting over 11% in a single day. If you're interested in this kind of real-time stock market analysis, please check out the link in the description below to join our trading community. It's $30 a month if you go for the annual Ghost Legend membership. I also post all sorts of things, including my weekly watch list and weekly expected moves for all sorts of stocks and ETFs, as well as every single trade and investment that I make in real time. I share all of my trades, all of my investments, as soon as I make them in real time in the trading community. Again, if you're interested, check out the link in the description below. I also make member exclusive videos, including a video on how to set up that CPC put to call ratio buy and sell signal. I also made, by the way, another alert for Google. And in the alert, I did say that Google will in fact be weaker than Microsoft and will likely retest the October 13th low. Here it is. Google delivered a bigger miss than Microsoft, and it hit its strongest core businesses, both YouTube and Google search. I think Google will show more significant weakness on the chart. Bears will likely push it down to retest the October 13th low at 95.5. And boom, we got that today with a close at $95. Now, this looks incredibly bad for Google, and maybe you will be tempted to short here. I personally would not, and here's why. Look at what happened after the company published its last earnings report. The exact same thing happened, right? We made a new low, taking out all the previous lows, and then the stock rallied and recovered. So be very careful shorting at these levels, especially with the CPC buy signal still active. this might not be the ideal short entry. Now, I'd be remiss if I did not mention the most important chart of the day. Every single day, really, this is the most important chart to look at. Up top is the smart money, down below is the dumb money, the S&P 500 down below, and high yield bonds are up top. We actually had the high yield bonds close above yesterday's high and taking out the October 18th high, invalidating the prior divergence that we've had. This indicates that more upside is likely coming. Now, this does not mean that we cannot see some choppiness, some weakness, some sell-offs in the interim, but so far the HYG continues to indicate that we're still squarely in an uptrend and that sell-offs and weakness should be bought to the upside, at least for now. And even if the market is rallying based on hopium, false hopes, FOMO, all of that horrible bad stuff, you do not want to fight the market. Let the market run. When it's time to short, we will short again. Now let's take a look at this seasonality chart. We haven't quite yet seen the typical sell-off towards the end of October that we tend to see in midterm years. This is another midterm year election seasonality chart, and we do tend to see a rally in October, but we also tend to see a sell-off towards the end of October. Now, this blue line is the exact same blue line up top. The red line is the most applicable because we are in the second year new Democratic president midterms. Now, there's also another seasonality chart that I pulled up today, and it's specific for bear markets. Again, bear markets tend to see some strength in October as well as in November, at least towards early November, before seeing another waterfall style sell-off, taking out the previous lows. Now, it is going to be very, very hard to determine whether we're going to see something like this with a lackluster December / second half of November, or if we are going to see something more in line with this midterm seasonality. So I'm keeping both charts in mind as I try to forecast what's going to happen next. Again, let's take a look at earnings. Tomorrow we'll have Shopify before the market open, as well as Caterpillar, McDonald's, MasterCard, and after the market close we'll have two massive behemoths, Apple and Amazon. Now, based on what we've seen from Microsoft and Alphabet, Apple and Amazon will likely miss. Amazon more likely than Apple. Shopify will be a bellwether for Amazon earnings. Microsoft is likely to be a bellwether for Apple earnings, especially MacBook sales, as we continue to see weakness in the PC market. Let's take a look at the economic calendar, everyone. Tomorrow we'll have the GDP growth revision, and Friday we'll have the dreaded PCE inflation report. So we have a double whammy. We have Amazon and Apple reporting after the market close on Thursday, and Friday morning before the market open we'll have the latest inflation figure coming out. So expect an explosion of volatility Friday morning. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.